Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Hello and welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And on today's video, we will be looking at currency. So currency exposure is a really important factor which can impact the total return of your investment portfolio if you're investing outside of Canada. So you need to consider the overall impact of currency fluctuations on your investments because the underlying investments in these ETFs can be bought and sold in foreign currency. So that appreciation or depreciation of the foreign currency against the Canadian dollar can either detract or it can add in some cases to your total return. So again, getting a handle on the impact of currency is really the focus of today. We'll dive into what is currency hedging, whether to hedge or not to hedge, or some considerations to think about when it comes to that decision, and how ETFs can be used really as a tool to help you navigate the currency exposure in your portfolio. Before we do get started, a quick reminder that today we're not providing investment advice or recommendations. Today's episode, just like all of our episodes for those just joining us, are all about providing education around ETF investing for Canadian do-it-yourself investors. Now, because today we are also joined by our BMO Investor Line partners, I have a second disclaimer to show you, and this states very much the same thing. This is not investment advice and for informational or educational purposes only. With that out of the way, I want to introduce my guests today. I'm joined by Om Karmakar, Portfolio Manager with BMO ETFs, no stranger to ETF Market Insights. Good to have you back, Om.
Thanks, Erin. Thanks for having me.
And then I'm also joined by our partners from BMO Investor Line. We have Jim Basra, who's Regional Sales Manager with Investor Line, who's going to walk us through some of the latest offers and exciting things happening at Investor Line at the end of the episode today. So thanks again, both of you, for joining me. Let's just dive right in to the topic du jour. Hoping you can introduce us and sort of level set, explain what exactly is currency hedging and how does it actually work?
Yeah, for sure. So before we dive into what currency hedging is, let's just figure out what hedging means, right? Hedging is another fancy way of saying having insurance on your portfolio, right? So, there's different ways you can hedge your portfolio. There's put options that you usually buy when you want to hedge your stock holdings. So that's like an insurance. If the stock price comes down, you have puts that provide insurance from that. On the currency side, you can hedge currency as well. It is an asset class. So it can be for currency. It is used to reduce your exposure or loss from that particular asset. In this case, if you are investing in, let's say, US based exchange, so you'd be, reducing your hedge from US dollars. So, hedging is in a way of shielding your investment from different asset classes. So in terms of currency hedging, you are shielding your investment from fluctuations in currency movements. Another way of looking at it is, as Canadian investors, we are always told to diversify your holdings. So we are always told to invest outside of Canada. So we tend to go invest in international markets, and especially in the US, south of the border. So if you go buy, let's say, Apple shares, you're getting two exposures in that. You're not only getting the performance of the Apple stock. So if Apple stock does well, yes, your portfolio goes up. But at the same time, you're also getting exposure to the US dollar versus the Canadian dollar. So if the US dollar appreciates, your portfolio will also go up because you are, in a way, buying US dollars to be able to hold Apple because it's traded in the US exchange. However, a lot of investors don't put a lot of thought on currency, which can be very volatile in the short term. In the long term, it tends to, average out. But in the short term, you can see fluctuations that can be counterintuitive. For example, Apple might be up 2%, But if the US dollar is down 2%, you're actually flat for the month, right? And we have seen that this year where, USD has been up significantly over a month versus Canadian dollar. And it has erased all the gains you got from kind of stock. So that's why, currency hedging is an important factor to look at when building out a portfolio.
And you touched on this, but that short-term versus long-term view and how currencies can move during that time frame. Give us some illustrations around how that volatility can actually impact a portfolio, shorter and longer term.
Yeah, for sure. So in the short term, it can be pretty volatile. A very good example is if we just go back in time and we look at in the month of August, we saw US dollar rally or appreciate versus the Canadian dollar by 2.5%. That's a big move for currency. So to put it in, another way is if you were hedged versus the US dollar, so that means you didn't have any exposure to the US dollar, your portfolio would have been flat. If the stock market wasn't going up during that month, it was pretty down. You didn't get any benefit from the US dollar. But, another simple example is let's just go to, 2008, the great financial crisis. During that period, USDCAD rallied. So if you're, as a Canadian investor, Canadian dollar depreciated by approximately 18%. And that's mainly because a lot of, investors across the world look at US dollar as a safe haven currency. So anytime there's turmoil in the short term, a lot of investors go and buy US dollars because they think, and which is true, USD tends to be a safe haven currency backed by the US government. Again, in the short term, tends to be very volatile. If you just go forward 1 year in 2009, Canadian dollar actually rallied back, as markets started coming back, there's fiscal policies, Canadian dollar actually rallied 17% back. So, if you're, let's say, long USD from 2008 till end of 2009, your return from currency was flat, right? Yes, in 2008, you got protection, but in 2009, you gave back majority of those returns. So yes, in short term, it can be very, very volatile. So it's very important to understand your overall portfolio construction and see how this fits into the portfolio. If you look at kind of long term, over a long term period, again, like I said, from a return perspective, they tend to average out. So I would say, again, depending on your time horizon, hedging or not hedging can be very independent.
Yeah, it's definitely an individual's decision, but I also think a good exercise is to just go on to, like, BMO ETFs has a comparison tool, for example, on our website, and you can type in ZSP and ZUE, so our S&P 500 exposures, hedged and unhedged. And that kind of gives you an idea, right? If you look at the shorter term, you'll see differences in performance, maybe larger differences in performance, depending on what's happening with currencies at the time. But if you're looking over 10 years, the difference is going to be minimal. So I always like to look at that tool as well, just to really wrap my head around it. There are a bunch of different factors that could and do impact currencies around the world. One obvious example I can think of is like monetary policy, which has been front and center this year. But walk us through some of these drivers and key things that are going on in the market that can have an impact on currency volatility.
For sure. I think you mentioned the most important one, monetary policy or interest rates, right? So if there's divergence in interest rates between different countries, it impacts currency value. So, we saw, for example, recently we saw Feds or even Bank of Canada start hiking interest rates compared to some of the other central banks, which are hiking, but not at the same pace as US dollar or the Canadian bank. And that's why we saw the US dollar rally against a lot of these currencies, right? So interest rate differential is one of the most important factors in determining currency value, but there are also a lot of different other factors that can impact the value in the shorter term. So another one is economic indicators. Right now, with inflation at all-time highs, with Feds, Bank of Canada, and all central banks across the world trying to tame inflation, right? looking at economic data is very important because it print on inflation that is higher than expectation can put Fed or Bank of Canada back on track on hiking. So if you do see that hiking cycle come back, we can see currencies start to rally again. So if you see Bank of Canada with higher inflation numbers, you can see Bank of Canada coming out and saying, hey, we're going to start hiking again, which would be a positive thing for Canadian dollar versus the US. So that's the second indicator that's very important. Third, I would say, is market sentiment. That is more, I would say, on the shorter term of the market or the currency valuation. And that's mainly because in the shorter term, what happens is, like I mentioned before, USD, it tends to be a safe haven currency. So if we do see some market turmoil, we see recession, we see geopolitical risks, very good example was March of 2020 when, COVID was just coming out, everyone was trying to figure out what's happening. A lot of demand for US dollar went up because everyone was buying USD to buy, US government bonds, and it's all traded in the in USD. And that's why demand for USD went up, and we saw strong rally in US dollar versus different currencies. So that's kind of the three main, I would say, indicators or three main drivers that impact volatility. And then there are some other factors as well. As Canadians, our economy is very, I would say, commodity driven economy. So oil prices or energy prices, commodity prices, so gold prices, they also drive the Canadian dollar. So, in recent times, we have seen a bit of a disconnect between energy prices and the Canadian dollar. The correlation used to be much higher. This year, we haven't seen that big of a correlation, even though energy prices have gone up. And that's mainly due to, I would say, one is the inflation focus by Bank of Canada. But again, as we start to come back and as inflation starts to come under control, we would see that correlation come back. And, for Canadian dollar, having strong energy prices is a good thing. Given that we are oil producer, we have a lot of gold. So these higher prices in commodity energy is a good thing versus kind of other foreign currencies as USD or even euro.
That's interesting about the commodities because, even though there's all these different drivers, some are going to outweigh others, right? And
exactly.
Being conscious of that is a good point. We talked about how the decision to hedge or not to hedge is ultimately an individual decision. And we talked a bit about time horizon, shorter time horizon. You might want to hedge to negate some of those shorter term fluctuations. Longer term, it's going to kind of bear even generally in most cases. But what are other considerations that investors should think about when deciding whether to hedge or not to hedge?
Yeah, for sure.
For us.
So I guess I'll mention time horizon again, because I think it's very important for investors to understand that, before making any decision, even if it's, buying stock or buying fixed income or bonds, one should really understand what their time horizon is, because based on that, everything else falls in place. So if you have a very short time horizon, having hedging currency makes sense because you don't want currency to dictate the return of your portfolio or outweigh the return of the underlying stocks. If it's, long term, it makes sense to leaving it a bit unhedged because we have seen currency, over the long term, it comes back to the mean average. For example, USDCAD over the last 5 to 10 years, on average, it trades around 1.3. Right now it's currently at 1.36, 1.37. Again, if your time horizon is, 6 months, 1 year, maybe the right path is to hedge. If your time horizon's 5 to 10 years, maybe, leaving some of it unhedged makes sense. Second, another important is looking at your overall portfolio construction and how that currency correlates with your investment. So for example, let's say, you're a retiree, you have 60% in fixed income, 70% in fixed income, 30% in stocks. You are conservative, you have saved up for retirement. Now it's time to withdraw from those savings. So it might make sense to hedge some of that risk away, not having that currency volatility in the portfolio and hedging that risk away. But let's say, you're on the other side of the spectrum, you're 35, 40, you have a lot of equity exposure, and, you have a longer time horizon. You have 20, 30-year time horizon. Having a little bit of US dollar exposure, or like leaving it unhedged, it's not bad, because like I mentioned, if there is economic downturn, if there is volatility from an equity perspective, US dollar tends to provide that diversification benefit. And that's why it can help mitigate some of those losses, versus a hedged strategy. Third, again, I would say this is also important, because a lot of people don't usually do this, but having an outlook on the currency. I think everyone has an outlook on equity market when they're investing in it. Everyone's like, I think Apple will do XYZ because of, they have good growth, they have good market share, whatever it might be. But they don't always say, hey, what about the currency side of things, right? As a Canadian investor, yes, Apple will do great, but what about USDCAD? So having an outlook on currency is important, and just thinking about where the long-term average is for this currency. And finally, I would say cost of hedging, right? Depending on which currencies you're hedging, there could be different costs associated with it. When you're hedging something like USD, it's not as expensive compared to if you're hedging emerging markets currency, such as the Turkish lira or the Indian rupees, right? So this cost of hedging comes into play, and that can impact your overall return, because you are paying this upfront as an insurance. So those are kind of the four main factors I would say one should walk through before deciding which way to lean.
Yeah, let's spend a bit more time on that last one, because in reading articles and even like on Reddit and things like that, there's a lot of talk about the overall cost of hedging.
Yeah.
What does this look like at BMO? Because you can only really speak for BMO, but like what does that cost look like from our perspective?
For sure. So I would say if we break down the cost of hedging, I would break it down into two things. One is explicit cost. So this is kind of the cost that you pay to hedge. So like your transaction cost, your bid and ask spreads when you are putting, from an explicit spread of cost, it's not very expensive, about, let's say, 1 basis points per month for majority of the currencies. So that equates to about 12 basis points on a yearly basis. So it's very minimal in terms of that. But there is, what I think is more important is the implicit cost of hedging, right? So if you look at the implicit cost of hedging, it can be very significant in terms of the volatility that brings into the portfolio. So if you look at a Canadian investor investing internationally, let's say an emerging market tends to be, the currency tends to be much more volatile. It's a very, another way of saying it, risk on currencies. So hedging in these markets tend to be more expensive compared to hedging in more developed markets. And the main reason why is because there's a lot more risk associated with emerging market, not just from a macroeconomic perspective, but also from a political perspective, right? Mm-hmm. Again, using Turkey as a very good example, because we have seen Turkish lira plummet in terms of their value versus the Canadian dollar. So imagine you went and bought, Turkish securities in Turkish lira. Yes, the cost of hedging was more expensive versus the US dollar. But if you look at kind of the currency value, it has plummeted much more than the cost of hedging that you paid for. So, those are kind of the main things in terms of cost of hedging. At BMO, what we do is we use currency forward contracts to do our hedging. We do it on a monthly basis instead of, there are strategies out there who'll hedge on a 1-year basis or 6-month basis. What we do is we do it on a monthly basis. It keeps the portfolio costs low. And like I mentioned, trading costs are very minimal. So, doing it on a monthly basis it doesn't get more expensive just because we're doing it on a monthly basis. And by using currency forward contracts, instead of using options, we are able to keep the overall cost of the program much lower as well. So I would say, those are kind of the two main costs. There's those explicit costs that, that everyone has to pay the transaction, but the implicit cost as well of making sure that you understand that if you don't hedge a currency, there are short-term negative impact that can have on the overall portfolio.
Okay, good insight. Thank you. So I am going to put up an image of all of the options at BMO ETFs because it is really amazing. We've come out with hedged and unhedged versions of so many of our ETFs with exposure outside of Canada. So a picture tells 1,000 words, and you can just see the flexibility that we've given investors to manage currencies in their portfolios. On top of hedged versus unhedged ETFs, we also offer US dollar ETFs. These are denoted by a .U at the end of the ticker. So ZSP.U, for example, means it trades in US dollars. And these are great solutions for snowbirds and also for Canadians who are just sitting on USD cash in their portfolios. But Owen, walk us through why these can be important tools for us as Canadians.
Yeah, for sure. I really like these ETFs. I personally use them, the .U ETFs. So I would break it down to three main benefits of our .U ETFs. First, as you mentioned, .U ETFs means they're US dollar denominated ETFs. It does not mean that they trade on the US exchange. It just means that they're USD denominated, but it trades on the TSX. So if you were to go and to your brokerage to buy it and you put the .U, you'll be able to buy it on the TSX. First, the biggest benefit is, you don't have to convert your Canadian dollars. You already have US dollars. You don't have to convert those US dollars back to Canadian dollars to buy ZSP, for example. If you already have those USD, you can go buy ZSP.U. So you save on that conversion fee. And we know that conversion fee can be quite substantial depending on where you exchange it, how much amount you're exchanging for, right? It can be anywhere from 1% to 5%, right? And that's a substantial fee. If you think of it from an overall long-term equity return, right? If overall 10-year equity returns about 10% and you're paying 3% on exchange fees or conversion fees, that's a chunky change right there, right? Second, I would say is it helps you match cash flows versus your expenses. A simple example is, a lot of Canadians like to leave Canada during the winter months and go to Florida. So you might have expenses that are in US dollars, right? Investing in these products, any dividend, any proceeds, any capital gains that happen within these ETFs are paid out in US dollars. So again, you don't have to worry about getting the dividends in Canadian dollars and then converting it back to USD. We also have covered call solutions in .U, like the Canadian banks, right? So you can get that exposure, but get all the dividends of the Canadian banks, get all that in USD. So that way, on a month-to-month basis, you're able to match your expenses with your cash flow without having to convert anything from CAD to USD or USD to CAD. And third is, given that these ETFs trade on the TSX, you don't have to worry about the US estate tax. And second one is, I think, correct me if I'm wrong, but I think the form is T1135.
Yeah, exactly.
Yeah. All right. So, again, you don't have to worry about any of these tax forms, which can be a hassle, right? Our goal at BMO ETF is to keep it simple for our investors, so then they don't have to worry about all the paperwork that comes with taxes. So, these are great solutions. And on top of it, right, if it's ZSP, which is our unhedged S&P 500, ZUE, which is our hedged S&P 500, or even ZSP.U, which is the US dollar denominated one. From our perspective, we want investors to invest in any of them. And that's why from our perspective, from a fee, we charge exactly the same across all three. We don't say, hey, hedging is, there's a cost to it, so we're going to charge more. We keep the cost consistent across all three of the ETFs, or all three different flavors of the same ETF. So that way, the end investor has a choice if they have a view on, hey, I want to have it hedged, I want to have it in USD. Yeah.
Perfect. Yeah, I think we could spend a whole episode. Maybe
Yeah.
we'll comment below if you want a snowbird episode. But yeah, that whole bit around U.S. estate tax and the T1135, which is such a pain for people investing in Canadian listed ETFs. Those assets are not counted towards that threshold for U.S. estate tax. So that's an important point and something we could definitely spend a whole half hour on.
Yeah.
And then to cap off, I would love to get your thoughts, your current views on CAD versus USD and where you think we're going for the remainder of the year.
Yeah, for sure. That's a tough question, right? It's only 1 month left. Very hard to answer what's going to happen in 1 month. But, I think from USD CAD perspective, I think, it's been trading in a range for last few months. The range has been around 1.3 to 1.4. And I think we continue within this range for at least a few more months. We recently saw, I think it was last week, a few days ago, we actually saw the US come out with their CPI data, which came in much lower than expectation. And we saw that's why the Canadian dollar got a bit of its strength back, given that, we saw market pricing it that the Feds won't do any more hikes, given weaker than expected inflation, which is a positive thing. But again, I think for USD CAD, going forward, it's going to be a few factors that determine where it goes. We think it'll trade between a range of 1.3 to 1.4. So around 1.4, we might start looking at hedging hedging US dollars. About 1.3, maybe buying some US dollars to get that exposure and that diversification in the portfolio. Energy prices will play a factor going forward. Oil prices have come down to about, I think $77 per barrel. If we do see that go back to 9,500, we could see a bit more strength come back into the Canadian dollar. Second is, any geopolitical tensions. So we are seeing geopolitical tensions across the world, but if they start to rise even more, we could see a bit more of US dollar buying there because of safe haven. Everyone likes USD when, markets and economies and geopolitics are going through the roof kind of thing. But again, I think our view is range bound between 1.3 to 1.4 for the next few months.
Okay. Thanks so much for that. Jim, thank you so much for joining us today from Investor Line. I'd love to turn it over to you to walk through some exciting offers going on right now at Investor Line.
Absolutely. Yep. Thanks for having me, Aaron. Hope everyone's doing well out there. So my name is Jim. I'm a regional sales manager with the Bank of Montreal Investor Line. I cover the GTA area in Ontario. So I'll be chatting about the promotions we have going on right now at Investor Line, as well as touching on our lineup of commission-free ETFs that we offer on our platforms. But before that, just a quick snapshot of the digital investing platforms or options that clients have at BMO. So we offer 3 distinct platforms, including our regular self-directed Investor Line accounts, which you see there on the left. Using the pilot analogy, clients are the pilots with this platform. They are in full control of their investments. They do their own research and their own trading. For clients who appreciate a bit more guidance and enjoy features such as buy, hold, and sell recommendations, we offer our Advice Direct platform, shown in the middle there. With this platform, clients are still in full control of their investments, but they do get a number of additional features, including an advisor to work with virtually. It's a great platform for those individuals who want to start investing on their own and perhaps have come from a full service brokerage. But they just need that little bit of extra guidance and support in making their investment decisions. So we call this our co-pilot platform. And then lastly, we have BMO Smartfolio. They're on the right. This is for clients who want a low-cost solution and a portfolio of ETFs that is aligned with their risk tolerance and time horizon. So Smartfolio is automatically adjusted. It's 100% managed for you. So you're not actually able to purchase individual ETFs on this platform like you are with self-directed and Advice Direct. So Smartfolio is kind of our autopilot option, so to speak. So now I'm just going to quickly run through the promotions that we have going on right now for clients who are new to Investor Line. Under our self-directed and advice direct platforms, we are currently offering cash back to clients who open and fund new accounts. So the promotion runs from November to January 8th. Clients have the opportunity to receive $3,500 in cash back. And you can see the different tiers there based on the size of the account. You can visit www.bmoinvestorline.com for further information on how to enroll. Or feel free to reach out to me directly as well. My email and phone number should be posted at the end of the presentation as well. I should also mention that we do have cashback promotion for existing clients of Investor Line as well. And that information can also be found on Investor Line's site when logging into your existing account. So moving on here, just touching on the commission-free ETFs that we offer. So we have over 80 ETFs that clients can buy and sell as much as they like without incurring trading fees. So the new suite of no commission fee ETFs, it covers a broad range of asset classes, geographies, management styles, and popular themes from the largest ETF providers. So not just BMO, but we do offer a number of ETFs from different providers as well. And we selected ETFs with the highest trading volumes and with the highest liquidity. So, and they provide options to kind of cover the full spectrum of investors out there. The list of ETFs that are available for commission-free trading can be accessed from the link there on the bottom of the screen, and we hope to continue adding more ETFs to this going forward. So that concludes my part of the presentation. Thanks very much for your time, and please do reach out to me if you have any questions or need anything. Always happy to help.
Thanks, Jim. I think there's some currency options on there too, just to tie it back to our discussion today, where
definitely are
flexibility on that as well. So thanks, Jim. Thanks, for all your insights around currencies. Next week on ETF Market Insights, Danielle and Matt Montemuro will be walking through one of the latest announcements, and this came from OSFI, and it pertains to HISA ETFs, or high interest savings ETFs, where OSFI is raising liquidity requirements for these high interest savings ETFs. And that's a move that will likely have negative impact on the rates offered by these popular ETFs. So expectation is that rates will go down in January when this takes effect. And we're going to be reviewing this announcement in more detail, and we'll discuss different options for investors who may be looking for an alternative place to park cash in their portfolios. So thanks for joining us again, and we will see you next week. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.